Everyone's running from this fund, and that's exactly why I'm all in. While investors are panicking about its past crashes and dividend cuts, I see something they're missing completely. Most investors behave like tourists avoiding a restaurant just because it looks empty from the outside. But what if I told you the chef just earned a Michelin star and nobody knows about it yet? This fund has been beaten down, written off, and labeled as toxic by the mainstream investment community. But here's what they don't understand. Sometimes the best opportunities come disguised as disasters. Today, I'm going to reveal why this 7.3% yielding ETF could potentially deliver double-digit total returns while everyone else is chasing overpriced dividend aristocrats. If you stick with me, I'll show you exactly why this contrarian play could be the income investment of the decade. But first, if this kind of contrarian analysis helps you see opportunities others miss, smash that like button. It really helps the channel and shows me you want more content like this. Picture this scenario. You're planning for retirement, or maybe you're already there, and you desperately need income from your investments. You look at treasury bonds and they're paying almost nothing after inflation eats away at your purchasing power. You check out those supposedly safe dividend aristocrats everyone talks about, but they're trading at sky-high valuations with yields barely above 2%. Meanwhile, inflation is running hot, your expenses keep climbing, and you're watching your real purchasing power erode month after month. The traditional safe income investments that financial advisors have been preaching for decades simply aren't cutting it anymore. You need yield, but you also need growth to keep up with rising costs. Most people think the solution is to chase whatever dividend ETF has the prettiest track record over the past decade. They want something that's never cut its dividend, never crashed, and always goes up and to the right. But what if I told you that this kind of thinking is exactly what keeps you poor? What if the real opportunity is hiding in plain sight, disguised as something most investors won't even touch? The fund I'm talking about is the Global X MLP ETF, ticker symbol MLPA. And yes, before you start typing angry comments, I know exactly what you're thinking. This thing has crashed multiple times over the past decade. It's cut its dividend on numerous occasions. The chart looks like a disaster, and most financial advisors would run screaming from this sector. But here's the thing about investing that most people never learn. Sometimes you have to look through the windshield instead of staring in the rearview mirror. When you're driving, you glance at that rearview mirror for context, but you make your decisions based on what's ahead of you. And what's ahead for MLPA is completely different from what's behind it. Let me tell you why this fund stands out from every other option in the MLP space. First, it has the lowest expense ratio at just 0.45%. While its main competitor, AMLP, charges 0.85%, and most actively managed funds in this space charge well over 1%. That difference compounds massively over time. Second, MLPA has no leverage on its balance sheet, which means it won't face margin calls during market crashes like some of those high-yielding closed-end funds that can implode when markets get ugly. But the real kicker is what this fund actually owns. We're talking about the blue-chip names that dominate the midstream energy infrastructure space. Enterprise Products Partners, Energy Transfer, MPLX, Western Midstream Partners, and Plains All-American Pipeline. These aren't speculative energy plays or wildcatters. These are the companies that own the critical infrastructure that moves energy around America, and they're absolutely essential to our economy. Now here's where it gets really interesting, and this is something most investors completely miss. If you've ever looked at investing in individual MLPs before, you probably ran into the K-1 tax form nightmare. Those forms are complicated. They arrive late, and they can create tax headaches that make your accountant charge you extra fees. Well, MLPA solves all of that. The fund holds all those K-1 generating MLPs internally and issues you a simple 1099 tax form, just like any regular stock or ETF. This means you get all the benefits of owning these high-yielding midstream companies without any of the tax complexity. It's like having a professional chef prepare a 5-course meal and serve it to you on a silver platter. This also makes MLPA perfect for retirement accounts like IRAs and 401ks, where you want to avoid the complicated tax issues that K-1s can create. In fact, I'd strongly suggest holding this in a retirement account rather than a taxable account because of how the fund is structured from a tax perspective. But here's the real transformation story that changes everything. The MLP sector has completely rebuilt itself over the past 5 years. Remember, these companies got crushed because they were over-leveraged and dependent on constantly issuing new equity to fund their growth. That model broke spectacularly in 2020, but it forced the entire sector to evolve. Now these companies have dramatically deleveraged their balance sheets. Their leverage ratios have plummeted across the board. Energy Transfer has a coverage ratio of about 2 times, Enterprise Products Partners has about 1.7 times, and MPLX has about 1.5 times. What this means in plain English is they generate way more cash than they need to pay their distributions, so they can fund their own growth internally without begging Wall Street for money. This is where the story gets really exciting, because we're looking at a perfect storm of catalysts that could drive this sector significantly higher. The Trump administration has created the most energy-friendly regulatory environment we've seen in decades. They're fast-tracking pipeline approvals, cutting red tape, and making it clear that American energy independence is a top priority. At the same time, the AI boom is creating massive demand for electricity and energy infrastructure. Every new data center that gets built needs enormous amounts of power, and that power has to get there through the exact infrastructure that these MLPs own and operate. We're also seeing the onshoring of American industrial activity, which creates even more demand for energy transportation and processing. Then you have the export boom. America has become an energy superpower, and we're exporting oil, natural gas, and refined products to countries all over the world. The Trump administration has been using energy exports as a bargaining chip in trade negotiations with China, Japan, South Korea, and Taiwan. Europe wants to reduce its dependence on Russian energy, which means more demand for American exports flowing through these MLP-owned pipelines and terminals. When you combine MLPA's current 7.3% yield with the likely 4% to 7% annualized distribution growth that the underlying companies are projecting, you're looking at potential total returns in the mid-teens annually. That's without even accounting for potential capital appreciation as the market starts to recognize the transformed fundamentals of this sector. And just to add some immediate catalyst fuel to the fire, the recent escalation between Israel and Iran has caused oil prices to spike, which generally makes the infrastructure that transports oil and gas more valuable. When energy prices rise, the toll roads of the energy world become more profitable. Now, I want to be crystal clear about something. I'm not suggesting you put your entire portfolio into MLPA. This is a concentrated sector play, and like any sector, it can go through rough patches. Smart diversification means combining this with other solid income funds like SCHD for broad market exposure or other ETF that give you different types of yield. But if you're building a portfolio of income-focused ETFs, MLPA deserves serious consideration. The combination of high current yield, strong growth prospects, simplified tax treatment, and multiple sector tailwinds creates a compelling opportunity that most investors are completely ignoring. The beauty of contrarian investing is that you get paid the most when you're willing to buy what others won't touch. Right now, while everyone is chasing the same overpriced dividend aristocrats, you can get a 7.3% yield with significant growth potential from companies that own absolutely critical infrastructure. This is the kind of opportunity that doesn't last forever. As more investors recognize the transformed fundamentals of the MLP sector and the multiple growth catalysts ahead, valuations will likely move higher. If you found this analysis helpful and want more contrarian income ideas that the mainstream is missing, make sure to subscribe and hit that notification bell. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching.